Data this morning from Empire Manufacturing was very weak, but inflation has been something like the opposite. Let's talk about the economy and the market with Barry Knapp joining us, the managing partner at Ironsides Macroeconomics. Barry, good morning. Thanks for being here.
Good morning.
Hey, did that 20 minutes of Kathy Wood sell you on Bitcoin?
No, I've been long a little bit all along. I read Hayek's The Denationalization of Money, decades ago, and was reasonably convinced by his arguments that private sector does a better job than government in just about every possible area. So why not money? So it's an interesting thesis, but I know all these arguments really well. I have a friend who runs a digital fund and a macro hedge fund, so I've heard these arguments before.
When you look at the way crypto markets have moved and the way the stock market has moved and the general kind of broadening and frothing up of risk assets, particularly in the last couple months, how does that reconcile with what we see in the economy?
Yeah, it's fascinating. I actually wrote a little bit about financial conditions last week. I'd been in New York for a couple of days, and that's one of the hardest questions to answer is, are financial conditions loose or tight? And the way I reconcile that is, if you are a part of the economy, an entity that is financed largely through the banking system and therefore at the whims of monetary policy, say, somebody who gets their financing from a small regional bank, small businesses, multifamily real estate, even the federal government to some extent, conditions are very tight. We haven't had this deeply of an inverted yield curve since the Volcker era. On the other hand, there's very, very loose fiscal policy, which is still creating a positive impulse into vast parts of the economy as well. That household sector in aggregate, right, termed out their mortgage debt and has received record levels of transfer payments. We've got all these fiscal spending programs that are driving liquidity into certain parts of the economy. So those parts of the economy, because fiscal policy is so loose, financial conditions are really loose as a consequence. And so, you just have this huge divergence depending upon whether you're more sensitive to monetary policy or fiscal policy. And that's one way of reconciling this huge divergence between, Bitcoin and other speculative assets rallying sharply at the same time that the Treasury market continues to struggle.
As we see bonds start to wake up a bit again here, it really seems like it took a bat to the head of 5 warm inflation prints to get yields moving again. What is with the conviction, I guess, that the market has or bond bulls have had to keep rates where they are, contained off the highs, when it looks like disinflation? I mean, looking at core CPI month over month, it looked like that stopped back in June. Core CPI month over month has either been sideways or higher, arguably trending higher since June last year.
Yeah, I didn't really understand the December pivot party that we had, the Feds almost seemingly patting themselves on the back because we had a period of disinflation. That disinflation was almost solely attributable to core goods prices. Goods prices were falling at almost as fast a rate as they were back in 2003, shortly after China entered WTO. And it was prices coming out of China, import prices slowing. If you look at those import prices now on a 6-month annualized basis, they've rebounded about 3%. And so, we were getting this disinflationary shock through goods at the same time that non-housing services inflation accelerated. We were printing 0.2s through July, and now we've been printing 0.4s. Housing inflation still hasn't come down as much as you'd expect. And so I wasn't really sure why the Fed was so confident that this disinflationary process was really going to head us back to target. I never really thought, again, because of my fiscal, concerns, that we were headed back to 2. So for me, if we do end up with a fairly aggressive Fed rate cutting cycle, it's going to be more because the Fed has to, meaning the labor market deteriorates further. And rather than just thinking we're going to get this immaculate disinflation. And I think the bond market's kind of woken up to that. We're right at the top of this year's range. And threatening a break higher, back perhaps even as high as we got to in late October.
It's a good way to kind of think about maybe why risk assets have been so optimistic if they were trading on the notion of an immaculate disinflation, a pivot to cuts out of convenience rather than necessity. If it's turning back towards necessity, we only get cuts if things break down. Should we be somewhere close to the top in risk assets?
We could be. I think it's a very narrow path to continue on the, tech-led rally in equities. There's two things that could disrupt it, right? One is that the labor market data doesn't deteriorate. The unemployment rate doesn't go through 4. Wage growth doesn't fall below 4. In which case, we've got an extra $500 billion in coupon issuance to absorb in the second quarter. Japan potentially ending yield curve control and negative rate policy, which could weaken demand from there, and the dollar potentially strengthening, which would weaken demand from all of Asian central banks. That sort of, rates going higher led by real rates, bear steepening like we had in the fall, could disrupt the markets. Alternatively, if the labor market does deteriorate, if this week's retail sales number was a sign that growth really is slowing back towards trend and people get concerned, about a growth scare or recession talk heats back up, well, you'd likely get something of a move lower risk off scenario in that outcome as well. I think the difference is, what do you buy, right? If we get our broad risk off because rates are moving up, it doesn't change the game plan, and you probably buy tech on that sell-off. If we do get this growth scare related sell-off, then you might be able to dip in and say, okay, well, now I can take a little bit of a shot at regional banks and maybe even small caps because, the Fed is going to cut back to 4, disinvert the curve, and open the bank credit channel. But I don't know, just continuing down this path seems like it's getting, sort of more narrow and narrower.
Mm-hmm. I like that point. It's an interesting one to kind of think about how cuts might spur rotation within the market. We've had this failure by the Russell to break out. For the most part, investors have been able to dismiss it if they're in the highly concentrated index or in the right tech names. But looking at small businesses, there's some pretty clear stresses here from a labor perspective. I'm looking at a chart from your report. Is it possible that that's contained the way the indexes are contained? Like, is it possible that we are seeing the same concentration in the indexes away from small caps, the way jobs are being concentrated away from small businesses?
Well, my caution with respect to that statement is that small business employment is hard to measure, at least by the BLS in real time. We've got this birth-death model, and they don't really have good data on deaths till more than a year after those businesses have shut their doors. And so when you look at things like the NFIB survey trending down, the chart that I'm showing, very weak growth in businesses with 1 to 49 employees from the ADP survey. And the NFIB survey at the lowest levels in quite some time. You'd look at this and go, we may just be deteriorating under the surface and really just don't know it yet. And with retail sales having weakened a lot, if you look at them on a year-on-year basis across a range of metrics, it's come down a lot over the last year as well. So we may very well be, weaker in our trend growth because of small business struggling with a tighter credit channel, much higher rates than the big numbers would actually lead you to imply. So I do have this lingering concern that the small business part of the economy, which is 60% of employment, is deteriorating, and we just don't know it, and the Fed just doesn't know it yet.
Barry, great stuff. Always appreciate your insight and the under the hood look at the economy. Good stuff. Very helpful for us.
All right, Oliver. Thank you.
All right, thanks for your time. Absolutely. Good thoughts, too, on the potential for rotation into some of the more cyclical stuff if there is a growth scare and the Fed's forced to cut. Barry Knapp, managing partner, Ironsides Macroeconomics.